Thank you, Angelica. Appreciate it. Thank you, everyone, for taking the time out. I've just scanned through the participant list, and we've got folks calling in or Zooming in from all over the world. So we're very excited to have you, and we're going to try to put on a dynamic show for you today around the topic. So what we're going to tackle today is sort of Cleantech 2.0, the green imperative, and we're going to do it with two outstanding guests. So we have Scott Gale coming to us from Halliburton Labs, and I'm going to give you a bit of his background, and then Grégoire Viasnoff from Schneider Electric. And Grégoire will correct me on the pronunciation of his name, even though I know it. I just can't seem to master it. So Scott comes to us from Halliburton, where he is effectively the founder of Halliburton Labs, executive director. He launched that organization in 2020, and he's hyper focused on investments and external engagements, focused on the clean energy community in Houston and around the world. He's working with multiple startups as a mentor, advisor, and investor. He comes out of Brigham Young University with a chemical engineering degree, and he spent the early part of his career in the petrochemical sector. So we're very, very excited to have Scott with us today. In addition, Grégoire is the Incubation Business Vice President at Schneider Electric. Schneider has a very active incubation practice. We've been very fortunate to have been partnered with them on a number of these, including companies like EIQ, Clipsal Solar, Dash Energy, and Atlantis, among others. And in addition to the incubation practice, Schneider Electric has a $600 million SE Ventures fund. Many of the investments there are focused on the circular economy and on what we would call kind of Cleantech 2.0. Grégoire formerly was in global deployment at EcoStruxure Power for Schneider Electric's buildings business. And this year, Schneider was named the most sustainable company in the world, according to Corporate Knights. So very excited to have the two of them on board. And then before we begin, I'll give you guys a little bit of my background. So I'm Paul Holland. I scanned through the panelist list. I know a whole bunch of you, or the participants list, know a whole bunch of you folks. So thanks for being willing to listen to my bio again. But briefly, I spent my operating career helping to start two startup companies, two software companies. One with Reed Hastings called Pure Software. We took that company public. It was acquired by IBM for about $2.5 billion. And then the other, where I went back to the venture capitalist who funded Pure, that was Andy Ratcliffe, who by then had founded Benchmark Capital. I joined Kana Communications with Mark Gainey and Michael Horvath, guys better known today as Strava. Kana, we took from 13 million to 9 billion in market cap in 27 months back in Internet 1.0. So after those two startups, I went to Foundation Capital, where I've spent the last 20 years, 18 of those as a general partner. At Foundation, we've invested about 4 billion of investor capital and turned it into about 480 billion of returns so far. Netflix being the biggest, but 28 other IPOs, including some of mine like Chegg and Mobile Iron and others. At Mach 49, I am the managing director of our venture division, and where we help people do things like start things like Halliburton Labs, but also to help people start new corporate venture groups or to optimize existing corporate venture groups. So that's the intro kind of background, whatever it might happen to be. I'm going to jump right in and start to ask questions of our terrific panel here. Scott, yeah, you can come off of mute, so we're good. So first, I guess what I would do is I'm going to ask Scott and Grégoire, I'll ask each of you to just give us a bit of an opening statement about why it is that you're on this panel, what's compelling to you about the topic, and sort of what you want people to know at the outset about the work that you're doing at Halliburton and at Schneider, and then we'll take it from there.
Sure, Paul, you want me to kick off?
Yeah, you bet, Scott. Yeah, I've got you first in the Zoom panel, so.
All right, super. Well, great to be with you this morning, and appreciate the opportunity to be a part of the discussion. So a couple of things come to mind. One, the energy transition, climate change, these kind of imperatives we believe are real. And there's a lot of evidence. We were chatting just kind of in the lead up to the panel here, and lots of evidence in terms of the kinds of things that are taking place out amongst the world that drive the imperative. And so one of the other things that sticks out is a lot of that innovation that is going to be required to kind of solve this big hairy challenge of climate change is going to come through early stage innovative companies, and the kinds of resources and support that they need on their journey are diverse. And particularly in and around energy startups, the need for help for hard tech, tangible tech kinds of things is one of the motivators for why Halliburton stood up Halliburton Labs, and some of the premise and recognizing the need and the gap there. And so for us, it's a recognition that it's real, it's change is coming. The energy system of the future will look very different. Pick your horizon, 2 years from now, 5 years from now, 50 years from now, it'll look very different than what it looks like today. And so just recognizing that lots of innovative changes are on the horizon, and being an active part of that is certainly one of the underpinning drivers for why I'm here and interested, and just love the topic.
Great. Thank you very much, Scott. I'm going to come back to you and get into some more detail on Halliburton Labs, because I think it's pretty fascinating. You started with a clean sheet of paper. In fact, it was probably March of last year, in the depths of COVID, that you sat in on this webinar and then stayed afterwards for the Q&A, and then contacted us, and then we moved forward and ended up where we are today. So I'm going to ask you to go into some more detail in a future question, but Grégoire, perhaps just start us off with, your responsibilities at Schneider, and what is it that drove your interest in taking up a slot here at on this panel?
Yeah, thanks, Paul, for the invitation, by the way. So really excited to be a part with this part of this panel, and to really explain what Schneider is doing in that regards. Right now, we are really facing a revolution. We are really facing a world which is fast growing, and you know that if you want to fuel any kind of growth, you need to have energy. Without energy, no growth is possible. And the big trend, and why it's a big revolution regarding the way energy is produced and consumed, is that if you really take the legacy way, which is a centralized way, mainly coal or oil fueled, it's completely unsustainable. And it is not a local problem, it's really a global problem, because the CO2 emitted in China is then going to US, and same from US to China. So that's really a big revolution that is happening in the energy sector. Probably the biggest over the last 2 or 3 centuries, or at least 2 centuries. And we are very excited in Schneider Electric, that is a technology enabler company, to provide the tool, mainly the hardware, but also especially all the software, the digital AI-powered capabilities that is driving a much more efficient world energy-wise. And we know that if you can really do more with less energy, which is really what is allowed now with the new technologies, this is, I would say, the path towards a much bigger and much more sustainable world. And this is what's our mission. Personally, I'm leading the incubation practice in Schneider. So as a corporate venture capital activity, we have organized ourselves across 3 practices: partnership, investment, and incubation. And concretely, incubation is either scouting very early stage companies, or we are incorporating our own companies, thanks to your help, Paul, all across the world, especially to target new things that will be very mature in 3 to 7 years from now. As you were rightly mentioning, circular economy is one of the hotspots of what we are really investigating, but many others, especially in carbon management. You know that, for example, right now in the world, everyone is starting to commit on their carbon neutrality by 2025, by 2030. But actually, in 90% of the case, it only encompasses what we call scope 1 and scope 2, which is your direct emission. But actually, the big bulk of the emission is what are your indirect emission, that we call scope 3. And this is something that we are very strongly considering right now, because it will be the future of a more sustainable world.
Thank you very much for that, Grégoire. So there's a lot to unpack there. So when I come back to you, I'm going to ask you to go into detail, because Schneider has a very robust structure. We use Schneider and Heriberto Diarte and Grégoire as examples all the time of sort of, kind of the goal that people should be shooting for from an innovation perspective. But I'm going to come back and ask you some more thoughts around what you're thinking of for future incubations, but also I'll dig in a little bit in some of the past incubations that you guys have done and explain kind of that concept a bit better. But Scott, let's go over to you. Let's go back in time. You know, we met, as we said. It's kind of fun that this is now happening with, you know, all the participants here that are zooming in. It was, I think, March of last year. I'd never heard your name. We'd never had an interaction with Halliburton. You came on, sat in on the, I think it was our how to start a CVC webinar or something along those lines. And then we began to talk to you, and he said, well, we have this idea. You know, my CEO, Jeff Miller, has this idea. And I said, wow, that's a pretty bold idea coming out of Houston, blank sheet of paper, maybe a room on a floor in a building. But why don't you walk us through what it is you've accomplished in this last year? Because I would have taken the under on what you've accomplished compared to what I thought was going to happen during that time period. You guys have been, and you and Dale and the team have been incredibly hardworking on what you put together there, but it's meaningful. So please go ahead.
Yeah, no, happy to. You know, leading up to that kind of fortuitous kind of moment where we connected, there had been kind of a lot of research and unpacking kind of principles around innovation, if you will. So there were a couple of books that we were digging into. There was kind of research that we were reaching out to kind of various folks that were kind of leading the charge on innovation. And we had kind of as a small team read a book about the founding and the history of Bell Labs called The Idea Factory. And it was kind of this look at kind of where does innovation come from? How do we disrupt ourselves as an organization? And how do we get involved in a unique way and in kind of a uniquely Halliburton way to address kind of this energy system of the future? And, you know, Halliburton is a well-established, been around for decades and decades. We're working on our second 100 years. We've been responsible for building a lot of the incumbent energy infrastructure that's out there. And so we felt like we brought a lot of unique skills and capabilities. But as you said, the ambition was on effectively a blank sheet of paper. We did not have a corporate venture arm, did not engage with early stage companies. Certainly we were focused on and continue to be as a corporation on upstream oil field services, but looking at how we might be able to apply those things differently. And so at the time, it was kind of like, hey, how do you go learn a bit about venturing? And as you said, we were in the kind of early throes of the pandemic. This was the first virtual conference that I attended at the time. And this kind of concept of having a virtual booth and was just kind of clicking around and happened upon the Mach 49 booth. And you and Linda were there and a handful of other folks. And it was kind of a small enough group who just sort of, hey, who are you and why are you here kind of thing. And we had our hypothesis in place and just kind of a willingness to get out and learn and understand kind of where was this niche, how would we characterize it, and how would we participate. And we're approaching, it was July 30th of last year, so about 361 days ago that we pushed a press release announcing the launch of Halliburton Labs. And so we made quick work of the design and planning and effort. And just not last Thursday, but the Thursday before, we launched our second round of curriculum with 8 participating companies, and just couldn't be more thrilled in terms of kind of the steps that we've taken, coming up on rounding the corner on a full year of kind of being out in the open, going from a place where only a handful of folks even had kind of the roughest concept of what it was we were going to go build, and to see it out there thriving and playing a role in supporting the startup community, not only here in the Houston area, but in the US and around the world, is really exciting. And so certainly could not have gotten to that state, again, given just the gap in our knowledge of where we were starting without the Mach 49 team. And so it's been just a fantastic engagement and really helped us kind of get off the mat and kind of turn it into a reality.
So I think one of the things I've been most impressed by is the maturity of the teams you've attracted in. So when I come back to you, I'm going to ask you some more about that. Like what's the, because I think often when people say, well, company X is going to kind of throw up a lab environment, you're going to get a bunch of people kind of like literally college students putting projects together and things like that. And I've seen, just incredible maturity. So I'm going to come back to you around that aspect of it. But I will just kind of give a tip of the cap to you and the team, including Mimi and Brad and the Mach 49 team that worked with you guys, because holy cow, does everybody know about Halliburton Labs? And you're not even 1 year in. Even folks within your community down there. And I think what you've done that is smart and innovative is you've made it clear that even folks that many people might think historically have been competitors to you guys, if they find somebody coming out of the labs that looks interesting to them, that they're welcome to put some funding behind it, or they're welcome to kind of get behind some of these things. So you're doing truly what I would describe kind of an open innovation initiative that helps the Houston area, but ultimately over time is really going to show benefit to Halliburton down the road, and the knowledge, the insight, and the access and things like that you guys have done. So we'll come back to that. But Grégoire, so as I intimated earlier, we often hold Schneider Electric up as really one of the gold standards around innovation more broadly. The work that Heriberto Diarte has done, and going back, working with folks like Emmanuel, and then working with you and working with Prashante and the team, it's a first-class team. You guys have a very ambitious kind of structure and an ambitious kind of mandate in terms of how you're thinking about this. But we use it as a model when we talk to people about saying, hey, there are several ways that you can really jumpstart innovation, jumpstart growth. In this case, you're jumpstarting growth, much of it around the circular economy and around climate tech and things like that. But tell us more about the philosophy at Schneider and how it is you got to a place where you've got this robust, high-performing SE Ventures that's out there doing really cutting-edge kind of CVC at scale, like writing much bigger checks than most CVCs are allowed to do, and really going on boards and things like that. But then also tell us, in some detail, what your mandate is around incubation. A lot of people, incubation means different things to different people. You all are very structured about this. Maybe go deep on that concept. What does the concept of incubation mean at Schneider Electric? What does it mean for you as the person that's going to be driving this going forward? And then I'll ask you a question or two about a couple of the ones that are really, really starting to break out, that have been in past classes of Schneider Electric incubations with us. But go ahead.
Thanks, Paul. Wow, what an intro and many questions. So I will try to answer all of them. So first of all, regarding our mission, we really think that, as I was mentioning in my intro, a revolution is happening right now. And even though if we are trying to pave that with our own, I would say, teams that are specialized in energy management and process automation, and even though if these teams are great, we really think that we are not the smartest in the world. The smartest in the world are really all these guys thinking about how locally they can disrupt this world. And this is why we have started this journey probably 3 years ago, when from the core, which is what Schneider Electric is doing on this energy management and process automation, we have added this dedicated innovation at the edge team. And the mission of this innovation at the edge is really to shape the Schneider Electric of 2025-2030. So it's how I can disrupt the core of what Schneider Electric is doing to be much more relevant with a new business model, with the new trends that are happening, because you all know that when you are a big corporate, you are not agile enough to navigate into these new big trends. So the mission of this innovation at the edge team, led by the people you were mentioning previously, is really to shape this Schneider Electric of 2030. So that's what we are doing, and therefore it's much more than just investing. Investing is, of course, one of the key levers we have with a $600 million fund with one limited partner, Schneider Electric, but it's not enough. It was only, if it was only money, we would not be, I would say, differentiate on the market. So that's why we have complemented that with two additional practices. One which is in charge of setting the partnership in between this ecosystem that we scout in the US. Half of our activities in the US, but half is outside of the US. So this partnership team is really trying to scout what is really happening, usually for more Series B, Series C startup, and trying to accelerate this innovation in between the core and this startup ecosystem. And of course, investment, once again, is part of this practice, but it's really supported with dedicated team that is driving that. Last but not least, this incubation practice that I'm leading. And here we are, as I was mentioning, mainly focusing on either very early stage concept or eventually really incubating from scratch, incorporating risk from scratch, new ventures. And this is, you're right, not unique, but not so often that CVC are doing so, because it means that we are taking, I would say, big bets on things that may happen in the future. And one of our strengths is that we are also incubating these topics in the geography where we see the markets are the most mature. So let me give you a few examples. For example, we all know that in the US, solar is right now booming. But actually, there is one place on Earth where solar maturity is even higher, which is Australia. So actually, we started this journey to learn this market in Australia with you, Paul. And we incubated Clipsal Solar at that time. And the way we are managing all these new things is always giving an unfair asset to the companies we are incorporating. And what is the unfair asset, for example, we gave to Clipsal Solar for residential application is we allow them to use a Clipsal brand. Clipsal is really the most famous brand in residential market in Australia. So we give them this opportunity to use this brand. And it's a completely autonomous venture, by the way, but they are really allowed to do that. And with them, we learn what solar residential business was meaning in the most mature countries. And now, with all these learnings, we are going very fast in the US, and we will expand in other geography as soon as this trend is moving to Europe and potentially later in Asia. But that's something, sometimes the reverse may happen. You are mentioning, for example, circular economy. Europe right now is probably the most mature geography for circular economy. We'll go stronger in the US and later in Asia. And therefore, we are right now incubating new models in Europe, targeting this circular economy topic. So how do we work? It's quite simple. We really take few domains. Let's take carbon management, for example, which is another one we are currently working with you, Paul. So really take this one, and we go very, very deep on the understanding on how the market is currently structured and how the market will be structured in 3 to 7 years to come. And this is why, for example, Scope 3 is one of the big trends that is just rising right now, but that will completely disrupt this carbon management topic. And once we have identified that, we are really scouting the best-in-class team, hiring CEOs, CTOs, CEOs. Some may come from the Schneider Electric core team, but guess what? In big corporates, you usually have great technical guys, but very limited serial entrepreneurs. This is not the DNA. So this is why we are really hiring all these leaders, these serial entrepreneurs from the outside and the external ecosystem. And we are shaping them a very agile venturing capabilities to drive with us these new ventures, always giving a kind of unfair asset to secure our investment and to secure that they will grow very, very fast. So that
one of the things I really like about what Schneider's doing and why we really, I mean, one, we have very deep engagement. We worked across multiple years with multiple kind of aspects to it. But just imagine, because many of you, I'm looking down the participants list, and I know a number of you, and you're really getting started on your innovation journey. You're considering starting on a CVC, you're considering starting an incubator, perhaps you're going to consider starting a lab. So we're going to go back over to Scott. in a moment around that. But what's cool about what Schneider's done is that I always use this analogy of like, how many arrows do you have in your quiver? You know, if you're an archer, and they have a lot of arrows in their quiver. They can reach back and pull out an arrow that says, let's not buy this company. Let's put $10 million in it and let's watch it for 18 months to see if it could be strategic for Schneider. Let's pull another arrow out, and I'll use Clipsal as an example. This was a fascinating project because when they came to Mach 49, at the time, of course, this is pre-pandemic, and so all the incubations were physical. Most of them were happening out of the Silicon Valley, and so they sent a team from Australia to the Silicon Valley. They lived in our offices for 12 to 14 weeks. We augmented them with some people from our network, which is often the case on many of these things, like we did with Scylla and EIQ and some of these other companies. And then they put together something that we were all so excited about by the time they finished. And then they got back on the plane, they went back to Australia, and they founded what I think is now universally regarded as the #1 solar company in Australia with Clipsal Solar. And I'll just kind of put a pin in this because many of you I know are in your organizations and you're looking for impact, right? I mean, you have activities, right? You've got some venture activity, you've got some initial elements of some incubation, wherever it might happen to be. But imagine you've got a Clipsal, which I'm not going to quote their revenue numbers. I know their revenue numbers, and Grégoire knows the revenue numbers, but they're stunning, right? And so if Clipsal were, you know, at Foundation Capital, my partner Steve Vassallo did the Series A in Sunrun, which is now the largest provider of residential solar in the United States, and you know, worth $10 billion or whatever it is. You know, if we had incubated Clipsal Solar and they were doing what I know they're doing today, the company would be on the way to being worth $1 billion as a startup, right? Just from where they are. But they're 100% owned inside of Schneider. So I think that's what's so powerful about this model and about the way we've seen some of this execution. So we're going to come back to this and we're going to dig in on some more detail. One thing I also want to note, because we've got such a phenomenal group, we've got about 100 people attending today, and I'm scanning through the list, and many of you are just, you know, serious multi-year practitioners in the area of innovation and so forth. We're going to do kind of an extended Q&A, and Angelica is going to help me with this. But I'm gonna probably go and suggest you know, a couple of names from some of the people on the list to have people weigh in to ask some questions, because not only are they going to be able to ask questions, but they've been doing some really cool work themselves. I mean, I'm looking at, you know, I can see IBM here, I can see Sony, I can see the guys at Doral Energy. There's some folks doing some really cool things here, so we're going to try to loop them into the conversation. But now let's get back over to Scott. And so many of the people that we talk to at Mach 49, one of the things that they wonder about is, you know, does it make sense for us to do XYZ Corp Labs? Like, does it make sense for us to do an open innovation forum, create some space for people, hope that that creates some of that entrepreneurial energy, creates a spark, whatever it might happen to be? Now, Scott, you've done it, right? So tell us what it's like to have gone through that process, put it together, and then what it means for the organization now. Again, when you were very quick, I think from the point that we met you, within 2 weeks, we were on with Jeff Miller, CEO of Halliburton, you know, Fortune 50 company, hearing his very focused and very serious intent about what he wanted to accomplish. But take us through that process and all the way to where you are today. Because one of the things that I'm struck by, as I said, is just the maturity of the entrepreneurs that you guys have brought in, and the interest of people wanting to be associated with this lab in the Houston area, where I would say it's safe to say, you know, Houston has not been the leading edge of this type of entrepreneurial activity. And I think you guys are trying to plug a gap there and really help the region on top of everything else. But please enlighten us on that, Scott.
Sure. Yeah, I mean, I think one of the things that stands out is you got to be really clear on what it is that you're solving for. And it's maybe sounds trite, but we had to be really clear about who we wanted to be, what the outcomes were that we were working towards, and who we weren't going to be. And one of the things really that became clear early on was one of the primary motivators for Halliburton to stand up something like a Halliburton Labs was really rooted in intellectual honesty and recognizing that we just didn't have a lot of the knowledge and background in a lot of the up and coming kind of clean energy areas. We just don't bump into those kinds of conversations through the run rate business. And so part of the goal was creating a completely net new source of information. And so by doing that, it kind of had a little bit of kind of an anti-CVC kind of premise, in the sense that we weren't investing in things that we had line of sight to in the run rate business, or that had any sort of connectivity to the business. In fact, it was intended to be the opposite. It was, we were only looking for things that we were not already working on or thinking about or solving for in the course of our day to day. And so that became important. The other, and was certainly a challenge early on, is that we did not begin with a fund. And so we were looking at other accelerator and kind of incubator type models, like a Y Combinator or other well-known ones that use a safe instrument to secure equity, but we were doing that for services in kind. And that can be a complicated conversation with entrepreneurs in terms of what are the direct and indirect value associated with participation, and selling entrepreneurs and founding teams on that. Now, while we give a little bit of prize money for the companies that are selected, it's not a valuation exercise. And so those were a couple of early constraints that kind of shaped and formed the stage of company that we target, and kind of the kinds of resources that we make available. And so the premise was really to create this open, collaborative environment where this intersection of investors and entrepreneurs, members of academia, and industrial capabilities in the form of Halliburton could come together to solve these clean energy challenges. And what we found is we wanted to have the right degree of technical risk in place. And so they had to be kind of far enough along that, you know, it wasn't just an idea on the back of a napkin. It wasn't going to be sort of a short, quick sprint kind of program. We wanted this to be a 1-year program. And so the kinds of companies that we ended up targeting are those that are pretty far along. They've got kind of a proof of concept in place. They're at or near first revenue. In many cases, they're pursuing their first institutional round of financing. And that has continued to be a hallmark of the targets of the kinds of companies that we look for. And so they're typically in that kind of seed to Series A bridge. Many of these companies get pretty far along on government grants and other things. But what we have found is certainly the de-risking element of participating with Halliburton Labs. We give these companies access to our facilities, our people, our network, and that is something that an early stage company needs in spades, and is certainly something that has been a bit of kind of a rallying cry in the Houston area, and has created kind of engagement and opportunity. And we've been very pleased with kind of where we've managed to kind of stick Halliburton Labs in the broader kind of entrepreneurial ecosystem. We joke that we share a fence line with a lot of different entities and incubators and university programs and government labs and other things. And the hypothesis was that there was just a gap in that kind of support, particularly for hardware-based companies, material science, chemistry, these kinds of things. It takes more patient capital. It takes more time to be able to de-risk technically and get to a point where they're preparing for scale. And so we really kind of shortly into the journey, I said, what are you solving for, and being clear on who you are. We wanted to be a world-class scalerator, and we wanted to be able to help companies prepare for scale and take that next step, and recognizing that that's something that as an organization we were pretty good at. We've spent 100 years taking energy technology to scale, and it was just the challenge of building the internal plumbing to be able to make that available to early stage companies and get all of that sorted out. And so, you know, we bring on 3 cohorts a year. Our application process is open year round, but we review those 3 times annually. We do a finalist pitch event and look to bring on kind of 3 to 5 companies in each of those rounds, with a goal of supporting 12 to 15 companies annually. And we're well on our way. We've done 2 of these events and had 2 selection rounds, and we're prepared and in kind of the process of gearing up for our September 30th pitch event. And so we're constantly scouting and looking, and we get lots of folks with ideas on the back of a napkin, and we pass them along to a Greentown Labs or the Rice Clean Energy Accelerator or something to kind of help them move along. But certainly, one last comment that I'll make kind of in and around this is very early on a whiteboard, just wrote the word reputation with the team. And that was kind of the goal, is we wanted to build this kind of world-class reputation for, if you're an early stage company working on tangible tech kind of challenges, that you should think about Halliburton Labs in terms of a step in your journey and being very clear about kind of where we fit.
That's super helpful. And thanks for walking us through kind of the mechanics of how it's working in the classes and vintages and things like that. So that's great. When we come back to you, before we go to Q&A, I'm going to ask you for sort of advice for people who are listening in, who might consider going down the path of the journey that you guys have taken, sort of the do's and don'ts, for lack of a better way to describe it. And Grégoire, before I go back over to you, Jonas had chimed in and reminded me that we need to do sort of a level set on kind of where we are in clean tech in general. And so I'm gonna spend a moment on that. And then later we'll like to invite our friend Nicolas Sauvage into the conversation during the Q&A part. Nicolas, of course, many of us know quite well, runs TDK Ventures. Nicolas prompted one of the reasons that this topic is where it is on the agenda today, and made it into the GCV kind of the webinar kind of agenda, is Nicolas started a dialogue with me and with Pete Moran. Pete is one of our what we call GPs in residence, general partners in residence at Mach 49. Pete's a phenomenal person and resource. He co-founded Dahl Capital Management, ran the firm for a number of years. Some of you guys may be following the press. It's kind of worth Googling it, but they just announced a recent fund. Looks like it's going to be a 30x fund, which that's a lot of money for whatever it was, probably a $400 million fund. So Pete's really one of the top practitioners in venture, period, now doing a bunch of really cool things on his own and health tech related ventures and things like that. But between Pete and me, I helped start and then ran the clean tech practice at Foundation for about 10 years. And Pete was in a similar role at DCM. We had a lot of scar tissue and a lot of kind of learnings. So Nicolas prompted a discussion around sort of the compare and contrast sort of clean tech 1.0 to clean tech 2.0. And so I'm going to spend a moment on that now, just to make sure that we're all level set here. So if I go back to Cleantech 1.0, when I began working on this with my partners at Foundation, it was 2002. And at the time, we realized that we were converging on a bunch of ideas that we called next generation industrial. That's what we thought was going to be the label for the, that's what we thought was going to be the label for this future industry. Well, after fighting that for a couple of years, we just succumbed to the label clean tech, because that's what everybody else was using. But in our mind, what we were looking for was not just simply new sources of energy, new types of solar panels. In fact, we didn't do a whole lot of that. What we were focused on was, how will industrial companies make themselves more efficient? The first place we focused was the utility grid. So we did companies like Silver Spring Networks, Enernoc, Control4, and others. And then we began to branch out and look at things. We did solar as a service with Sunrun and with Azure Power in India and things like that. But I would say Cleantech 1.0 had a number of characteristics associated with it. One, it was largely driven as almost like a social movement. So remember, it was Al Gore, Inconvenient Truth, that really popularized the concept of climate change for many, many people. Obviously introduced it as a, what is in my mind kind of a needlessly controversial topic in the public polity. But that became this kind of groundswell. At the same time, there were very forward-looking people, executives in these large industrial companies, that were realizing, hey, software is this big new thing. We've got to modernize our practices as it relates to software. This was less about climate change and saving the planet. It was more like, boy, we're doing way too many things on an analog basis. We got to move our business to digital. So at Foundation and other places, we got behind these large industrial companies that were doing digital innovation, and really kind of funded a bunch of companies around that, with this aura of kind of clean tech and then ultimately climate change. Then the other big factor that kicked in was, with the Obama administration coming in, the Great Recession kicking in 08 and 09, was the ARRA, so the American Recovery Act, driven by the Department of Energy. That was, hundreds of billions of dollars that were then pushed out into the economy around trying to accelerate basically the green economy. And some of those things ended up in solar PPA companies, and some of those things ended up in other places where eventually some of them died, and it was pretty notable, and there were a lot of press coverage about the things that died and the money that was sort of wasted, as it were. But there were a lot of seeds that were planted during that era of Cleantech 1.0. Cleantech 1.0 sort of came to an end, mostly, in my opinion, because of the natural behavior of the hype cycle. If you guys follow Gartner or Google, the hype cycle, you go through this, this huge uptick, and then you go into what's the trough of disillusionment or trough of disappointment. And so there were a couple of things that happened there. One, valuations got way, way ahead of where they were. Industrial companies trade at a certain range, and the valuations of the startups at that time were trading way ahead of those ranges. Two, the general economy kind of collapsed. Three, people weren't thinking as much about clean tech anymore as they were about just simply restarting the economy. So there was a higher priority that kicked in. So with Cleantech 1.0 sort of crashed, as it were, and there were a number of people who kind of abandoned the space. And in abandoning the space from an investment perspective is a good thing for the health of it, right? Because there was just too much money chasing too few deals, as it were. So the market, I would say, sort of normalized after this. It sort of settled down and normalized. But meanwhile, what was going on in the background were there were all these companies that were funded during Cleantech 1.0 that were sort of idling a little bit. They weren't yet roaring to life, but they were kind of in the background. There were companies with these weird names like Tesla and Silver Spring Networks and Solar City and Sunrun and these other things that had all been funded during that first wave. And then I would say Cleantech 2.0, and this is articulated in this article that Nicola is working on, really has now kind of come roaring to the forefront. And for me, and I'm going to turn this over to Grégoire to kind of carry on this discussion, but to me, the biggest change between Cleantech 1.0 and Cleantech 2.0 is one, Cleantech 2.0, as is often the case in these hype cycle kind of concepts, is 10 times bigger than where we were in Cleantech 1.0. And the primary reason for that is large companies are involved this time. If you look back in 2002, 2003, 2004, 2005, and you look at the public statements by executives of energy extraction companies, of industrial companies, chemical companies, you'll generally find almost like well, certainly very resistant kind of points of view around it, and almost like militantly resistant to that. If you look at where we are today, the public consciousness has changed. We're a half a generation into the Gen Z community. That group, I've got 3 girls in college at the same time. They're all super into this. I know all of our kids are into this, and they're expecting to see action, right? So what I see out of this, I see consumers are driving some of this. The industrial companies are driving themselves. And more importantly, the business imperative is driving it. There's a market now for what's called electric cars, right? There's a market for the charging systems that are out there that are needed. There's a market for clean energy, renewable energy. These are all things that have come to the fore. So in my mind, Cleantech 2.0 is like a sequel of a movie that's bigger than the first one, going to be more impactful than the first one. Eventually, it'll have its own hype cycle effects because that's just the way things work out. But that's where kind of I see it. And then I'll put a little punctuation thing on this. I am aware of funds, and I won't name the individual funds, although they're not going to mind because this is a good story. But there are funds that when I was running Cleantech Foundation, I would hang out with the other people that were doing the same at some of the big firms that are out there, venture firms that are out there. And one in particular, I remember speaking to one of the top partners at this firm, and they said, we deployed about $400 million into Cleantech related investments. This is one of the 5 or 6 like best known firms that were putting a lot of money into Cleantech 1.0. And at one point we were carrying that 400 million at 200 million because the hype cycle kicked in, the crash had occurred, valuations had compacted. And so they were not feeling too great about things. That 200 million later turned into 1.6 billion. Because some of those little percolating companies that turned out to be mega hits were in their portfolio. And now, good Lord, if they'd held, it wouldn't be 1.6 billion, it would be 16 billion or 25 billion or something like that that are in that portfolio. That concept has actually happened at a bunch of different firms. And so now what we're seeing from the venture side and the innovation side is you're seeing very intense interest because you see actual real business that's coming out of this. So sorry for the long-winded explanation, but I'm trying to give you the benefit of, decade plus of sitting in partner meetings, making judgments around clean tech investments, and also other people that are doing the same. So now for those of you, and most of the people that are in our attendee list are representing large companies. For those of you in large companies, it almost feels like everyone's kind of put their shoulder behind the wheel here and are pushing forward on this. So I'll stop with my kind of soapbox speech. I'll turn it over to Grégoire to get some reactions, and then same with Scott. And then I think what we'll do is we'll move, once we get a couple comments out of our panelists, we're going to move to Q&A, and Angelica will start to give some people a chance to kind of pop in with some thoughts. I'll help you curate that. So go ahead, Grégoire.
Okay, thanks. Very, very well aligned with what you have said, and definitely this Cleantech 2.0 is moving from a very, very conjunctural approach to a very structural approach. And why I mean that it's a structural approach, because you align all the stars that are needed to change the frame, to change the way our societies are built. And it starts from, I would say, public and governments commitments. In US, you have seen the Biden administration really changing the paradigm here, but the same in Europe. As you know, China has taken its 2060 carbon neutrality pledge. So that's all the global geographies from the government side that are now taking some very strong and bold commitment. But it's complemented with finance. You have seen now that green finance is booming, which means that people that are financing the big infrastructure project and so on are really now putting some real criteria before financing a project that would not be carbon friendly. Then complemented with real oil and gas companies. You have seen now how Shell, for example, is really stating that the peak oil is over and have massively invested in renewable all across its practices. Fortune 500 companies are now committed to really deliver a much more carbon-friendly world. More than 30% of them have already taken some carbon neutrality bets. But it's also pushed by real B2C, all the B2C companies that are pushed by their shareholders, because they have seen that the share price is really much better when the companies are sustainable, and they are pushed by their own customers that are asking to have, I would say, much more sustainable companies. And then last but not least, the sixth star are the consumers themselves. You have seen right now, for example, in California, that the fire season is extended by weeks, and it's really directly linked to the global warming. So that's, everyone has that in mind. So when you align at a global scale from government, business, finance, and consumer, that's a very strong structural wave that is happening, going much beyond some forward-looking people. And that's where we are right now.
Terrific. Scott, over to you.
Yeah, I'll just kind of pull on the thread a little bit around kind of consumer engagement. I think certainly it's one of the things, in addition to investor sentiment, but also the consumer behavior. One of the things that I think is going to be critical to kind of keep the momentum for kind of this climate tech wave and kind of the 2.0 is, you've heard me kind of talk about, the bad guy in the narrative is carbon. And it's one of these things, though, that like at the consumer level, much like the organic food movement or other things that's driving kind of changes in consumer behavior, the average consumer doesn't have a great grasp on carbon impact in like the decisions that we make in our day-to-day lives. If I were to ask you how many grams of sugar are in a Kit Kat bar, any one of us would probably be in the zip code, 20 grams, 40 grams, whatever that might be. But if I was to say how many pounds of CO2 went into making the pair of sneakers that I'm wearing, like you wouldn't have like it could be 20 pounds, it could be 2,000 pounds. Like you just don't have a good grasp on the impact. And then is that a lot? Is that, it's a relative kind of conversation. And so I really do think that this idea of carbon being the new calorie is an important component of solving for the right thing as a society and as kind of as kind of this technologies kind of come forward, because we have to have a common metric. And I think that's one of the things that still is to come, and will be, and I think play an important role in kind of determining kind of winners and losers and all of those kinds of things. So just to kind of add to that, to the overall discussion, because the things that have been stated very much agree with and kind of see some of that shift and change. Certainly the conversations in boardrooms, certainly the conversations from investors and from consumers as well, is going to drive adoption of those technologies. And the last thing is to kind of say, you know, we've got to rethink our impact as humans on the planet and the kinds of decisions that we make. And there's going to be probably quality of life trade-offs that are going to come with that if we're really going to achieve the carbon targets that we've set out to accomplish in the coming decades. And so it really is, I think the momentum is there. You see the investment, you see the impact, but we've still got a long road to hoe.
So I think, you know, what I find striking about this, listening to two of the largest companies in the world, in Halliburton and in Schneider, is that, you know, how far behind some of the public policy people are on this discussion. There's this whole kind of notion of like, are corporations too woke? Are they paying too much attention to these type of things? And it's like, it's less in my mind, are they too woke when it comes to climate tech and things like that? It's just that there are people like the people on this panel who have actually spent the time on this and have become very knowledgeable. And then their executive teams are also beginning to spend the time, and the boards around it. So the consciousness has really changed, as I indicated. So we got a bunch of questions streaming in, which is awesome. So what we're going to do is some of them I'll abstract and we'll kind of take care of as moderator, and then some others will do a bit of a spotlight. So Raymond, be prepared. We're going to let you kind of come on and join the discussion with your question, and then Nicola will follow with you on that. But Svenja is asking a question. Can you elaborate on the understanding how to distinguish Cleantech 2.0 and climate tech in terms of segmenting the verticals? What's included and excluded, and where do they overlap? So I'll try to take a shot at this one, because the next are going to be more specific for the panelists. I think these days, the way I think of it is the terms are being used interchangeably. I think if I were to try to, you know, split hairs on this and parse it down more specifically, I'd say that there are probably things that are happening in clean tech that may not necessarily have as much of a climate imperative. So for example, you might be a chemical company and you're looking for a new way to run your refining processes more efficiently. From that perspective, that will have a corollary impact on climate tech, but it's not the primary focus being that. Now, there are going to be other initiatives that are happening, some of them, you know, through people like Breakthrough Energy and Gates Foundation and places like that, that are almost like a not-for-profit type of focus that is purely focused on climate tech. You know, there are companies that are focused now on trying to figure out a way to, you know, to mitigate the impacts of some of the methane producing either machinery or agriculture, or whatever it might happen to be. Some of those are businesses, and some of those, frankly, are more phenomena that people are trying to fund in some way, just simply to help the climate tech initiative. I mean, it's a very topical question for me. My daughter Kylie, my oldest daughter, she's in venture this summer. She's a summer associate with Equinor Ventures, doing climate tech related investing with them and research and things like that. So it's fun to kind of get that. Trevor Venda asks for Grégoire, where do you see AI fitting into the energy transition, Cleantech 2.0? Most of the existing assets, infrastructure, have no real inherent IT capability. And if they do, I'll just add on, it's probably not cloud enabled, and it's probably not AI driven. So how do you think about that, Grégoire?
Yeah, very, very good question. The good news is that it's really happening now, because actually in most of the critical infrastructures that are the most relevant in terms of efficiency, data are existing. They are just hosted on site on what we call edge software in most of the time, and therefore are not AI powered. You're absolutely right. And here there is, I would say, two underlying questions. Which one? The first one, as you were mentioning, is how I can open this data to share this data on a much more open manner to allow AI capabilities to drive efficiency. That's one. And the second one, which is clearly linked to that, is the cybersecurity of these infrastructures. So you need to know where your data are hosted and are they securely hosted. So right now, the good news is that we are really seeing big trends, including for some of the utilities, which usually are the most conservative customers, to open their databases to allow AI to drive efficiency for more resilient infrastructure. So it's really happening now, thanks to mainly the fact that we are better understanding how to protect in the cloud the data in terms of privacy rules and cybersecurity constraints. That's one. But it's also going to happen at scale because, for example, right now in the electricity sector, in Europe and in China, we are really launching electrical panels that are natively connected to the cloud. So thanks to LP1 technologies, that are bypassing the IT infrastructure of the customers, these installations are directly natively connected to the cloud and sharing at least their health status to the cloud. So it's really the beginning of an AI at scale capability.
Fantastic. Thank you very much on that. So we brought Raymond on to ask his question directly of the panelists. So please go ahead.
Hey, thank you very much, Paul, to host this, and Scott and Grégoire, thank you for a very great session. So I'm calling from Honda Innovations. It's sort of an innovation lab. So my question to both of you, actually, great achievement. Happy to hear what you guys can achieve and are achieving. The challenge we have is actually, our innovation lab is called a grassroots. Right? It's right now very hard to get upper management, like the top leadership, to put up the money and understanding the imperative of what we are doing. So I'm asking both of you to kind of give a little bit of context or background of that work. Do you have to do a lot to convince your leadership to invest into something that you do?
I'm happy to kick off. I would say that you can't ever stop selling internally. Even if you've got kind of initial support, you've constantly got to be checking in with leadership and ensuring that they're aligned, particularly if you're working for a publicly traded company. There's quarterly requirements, there's different expectations from a big corporate. And so certainly achieving early buy-in is key, getting it up and off the mat. Corporations are well designed and built to self-preserve, and so anything new that shows up on the scene is treated like a foreign body and is potentially something to be killed. And so I call it the weight of incumbency, just sort of the momentum and movement of an organization, and fighting that for sure can be a challenge. And so frankly, I would say it's a constant thing that needs to be thought about, addressed, and executed on, and something that you really can't take your eye off the ball.
Fully aligned. So fortunately for us, we have really a strong buy-in from the top leadership, really acknowledging that people are smarter outside, and therefore you need to shape a different vehicle to grab this innovation. And it's not you. Clayton Christensen clearly mentioned it, and this innovator dilemma, which is if you really start to drive everything from the core, especially from big corporates, it's just impossible. You are asking, I would say, a very lean and efficient boat to grab very uncertain and a disruptive technology. So it cannot match, and therefore it requires a dedicated setup with a strong sponsorship from the top, especially because the time frame is in most of the cases slightly different. So on one hand, you are quarterly incentivized. On the other hand, especially from the incubation practice, but it's also the same for a pure investment practice, it pays over years. So so that's something that definitely needs a strong sponsorship.
Fantastic. We're going to get our next question directly from our friend Nicolas Savage, who should be joining us. Thank you, Raymond, for that. We're going to drop you out and bring the other group in. So. Angela is trying to execute on this. Let's see. All right, Angelica, sorry. Hello. Here we go. Right, there he is. All right.
Okay, it looks like I had to rejoin, so sorry for the delay. I think my question was really simple. It's how does a panelist think about carbon capture solutions? And clearly, one is how do you invest in startups where there's so much externalities they don't control? A lot of things that will change their trajectory is outside their control. Two, and this is really something I'm challenged thinking about it, so hopefully you can help me, is if these carbon solutions, carbon capture solutions do really, really well. Actually, that's not necessarily good for all the renewable energy that needs to actually have a good unit economics compared to the competition. So how do you think about these two? How do you reconcile it? And how do you think about investing in really good startups in carbon capture?
Want to start with this one, Grégoire?
Look at that.
A couple of comments. I mean, I think it's a great question. I think that carbon capture, sequestration, utilization, kind of the putting carbon to work. You know, I mentioned that carbon is kind of considered the bad guy, and I don't actually agree with that. I think obviously if you take a step back, and being a chemical engineer, I took a lot of organic chemistry classes. Carbon's in everything, and so there's a lot of uses for carbon, obviously. And so I think, though, that in the mosaic of technologies that are going to be required to help us get to this kind of carbon neutral future, it will play a role. I think there's certainly when the incumbent energy organizations kind of think about it, there's a lot of skill sets that are required: reservoir characterization, managing carbon, punching holes in the ground, and putting the carbon in place. So from a technology risk standpoint, it's a pretty short putt to kind of get to some of these kind of carbon sequestration kinds of activities. We've been doing it for decades, and so it's just a matter of doing it at a different scale. And so I think it plays a role. I think there's certainly questions about it, and I'm personally a bigger fan of upcycling carbon and finding ways to utilize carbon versus just kind of tucking it away in the ground and hoping that we don't see it again, you know, in the next number of centuries. So I think we've got to be careful about it as being kind of you know, the catch-all of everything. But we've got a lot of work to do, not only in reducing the carbon emissions of just human activity on the planet generally, and certainly capturing and sequestering and kind of putting to work carbon has to play a role. So I think it's a thing. It needs to be a thing, requires investment, but certainly worth digging into maybe some more of the details over a drink sometime or something. But
so, and just to add on top of what Scott's mentioned, for me, it's not either renewable or CCUS. It's both. Keep in mind that right now we are really struggling to be back to a kind of +2 degree trajectory. But even if it's a +2 degree trajectory, it remains +2. Which is a shame, you know, and it doesn't really take care about also all the decades where we have over-emitted CO2, which means that to clean all that mess will take decades. So CCUS is absolutely mandatory to complement what's gonna be, I would say, improved by renewables, improved by energy efficiency, and needing, I would say, the third wave, we need to continue to clean all this GHG gas emission. So that's one. Now also perfectly aligned with what Scott was mentioning. For me, the most sustainable companies in CCUS are the ones that are rethinking the way we can use CO2, which is not only to sequester the CO2 somewhere in the ground, but really putting that in a new way of utilizing the CO2. So this is the criteria we are more considering when it goes to a sustainable investment. Now, I think for at least the years to come, it will be highly needed.
Yeah, and I think what you're describing with this upscaling and reuse of the carbon is that could also drive better unit economics for these startups.
Yeah.
Okay. All right.
Perfectly.
Fantastic. Thank you for that, Nicola, for weighing in. And Nicola, while we have you, I know you have a fascinating panel coming up. You want to give us a plug on your panel and when that's going to happen? Because I know a lot of people are going to want to sit in and listen to that. I think many of you know the story of Nicola and TDK, but off to arguably the fastest start in the history of CVC. 2 years in, 15 investments, 3 exits, multiple unicorns. Just a lot of really cool stuff going on. But Nicola's going to give us a tutorial. You want to give us 30 seconds on that, and then we'll move on to, I think Peter is going to be next up.
Okay. Well, first, we have number 17 just announced last week, Fabricate. So we had 17 now. So it was not a planned plug, so I want to make very clear to everyone. But yes, I'm going to be speaking about our experience at TDK Ventures to raise our second fund. So any corporate VCs that even are starting or thinking about starting, I think knowing what Fund 2 will look like for raising is useful to raise Fund 1 and set the right expectations. So hopefully it's useful for many of the new corporate ventures, and there are many, many new corporate ventures. So I wanted to help the ecosystem by sharing our own experience. A year ago, I shared the experience of starting a corporate VC, and this time I'm talking about how to raise our second fund. And yes, we tripled the size of our Fund 2 compared to Fund 1. And this is really exciting, and hopefully you find something useful. Don't hesitate to reach out to me if you have any questions after the keynote.
All right, so we'll put the date and time in the chat so everybody has a chance to be able to see that. So thank you, Nicola. Appreciate that. Before we go to Peter, I'm gonna we had an anonymous attendee who's asking a question. Often I'm an anonymous attendee because I can't figure out how to get my identification on these things. So that this may be a truly anonymous attendee, but they're asking, and I'll go ahead and take this one, to speak to the disrupting internal processes and business thinking. Does that lead to conflict between your goals and the goals of the business? How do you overcome that? This is something that I'm sure Scott and Grégoire could go into a lot of detail. We're working with about 35 of the Global 1000 at Mach 49, and this is a very common phenomenon. And so what we see here is that when you first start, like kind of where Scott was getting started, or where the early days of what was happening at Schneider, you're kind of like what I would call the grit and the oyster. You're sort of the exception, and then you're just grinding around, trying to create that pearl right within the oyster. And then what happens is, as these processes begin, and if I look at what Nicola accomplished, for example, at TDK, initially lots of skepticism around these new initiatives, these growth initiatives. We've done it before. Oh, this will never work if we do a CVC, where it might happen to be. And then gradually, as you begin to get bits and bits of evidence, and that you're moving in the right direction, whether it's creating an incubation group, creating a laboratory, like a Halliburton Labs, or creating a CVC, then as that evidence begins to mount, pretty quickly the opposition drifts away. And then what I call a bit flip, like a semiconductor process, where you're here and then boom, all of a sudden everybody's behind you. They're on your side. They want to see this succeed. Part of the reason for that is that this whole concept, everything we're talking about today, the reason there are 100 people on here is that this whole concept of what we're talking about has gone to the top of the board book. How to do innovation inside of large organizations, how to tackle the big problems like climate tech and clean tech, things like that. And so as a consequence, we're seeing executive involvement and CEO involvement at levels we've never seen before on other initiatives. Not even, if I go back to my experience with Internet 1.0, there's even more activity now happening around these large companies, because nobody wants to be the next Kodak, right? And so people are working really, really hard to create these innovation, create this growth. So I'll take that one. And let's see, Angelica, I think we're going to fade Nicola out. And we got a question from Peter Harris. And so I don't know, maybe Peter, maybe somebody else signed in as Peter. I'll go ahead and take it unless we can get Peter on. So the question is around how do you think about solutions for scaling hardware and infrastructure companies? and the high capital costs required. Solar and wind are now at parity in certain markets. EV batteries are getting there, but it took years of non-financial return, seeking sources of capital, e.g. government funding, subsidies, tax breaks, et cetera. Paul, you mentioned Sunrun and solar as a service. Maybe let's hear a bit more about what the constraints and hurdles were for those guys to get in the market, to achieve adoption, et cetera. And then what are additional solutions to high-end capital nature startup businesses and so forth. Okay, so I'm going to go back in time, and I'm going to try to tackle this question, and then I'll let Scott and Grégoire kind of tackle it. The way I'm interpreting this is, how do you get uneconomic solutions started inside these large organizations into the market and funded to where they can become economical solutions, right? I think solar as a service is a perfect example for that. It is completely upside down economically when you get started. You've got capital equipment costs, you've got leasing costs, you've got installation costs, you've got to run trucks, you've got to have maintenance people, et cetera. So I'll tell the story from the Sunrun perspective, and my partner Steve Vassallo would be way better at this because he was on the front lines. I was sort of in the bleachers watching this. But when Lynn Jurich and the team got started with Sunrun, their initial vision was, we think if we can create an alternative financing vehicle, then we can get more people to put solar on their homes. And so when Steve funded Sunrun, I think they had 7 houses that had taken solar on, and they had cobbled it together. They cobbled together the financing and things like that. So the premise behind solar as a service was, if we can raise large pools of capital some way or another, then we can allow people to finance their energy in the same way they finance cable in their home. Like, nobody would think, if I want to get cable for my home, I'm going to go write a check to Comcast or Xfinity or whatever for $10,000. Nobody does that. What they do instead is, Comcast and AT&T and others have raised sufficient pools of capital to where they can come in and install the equipment for you and charge you by the month, kind of charge you by the drink. That was the model that Sunrun pioneered for the residential market, which is, how do we get to that place? And the way they got to that place was through just absolutely extraordinary effort. So first, you had to go back in time. My partner Steve funded Sunrun, I think, in April of 2008. So just as the world was about to unravel and come apart, right? I think he put $7 million in the company for 35% of the company. So obviously it was a spectacular investment, and continues to be until this day. However, there was this big elephant in the room, which is, how do you get these installations financed? How do you get to a place where people can just pay their energy bill by the month, but they don't have to write these $100,000, $200,000 checks to get these things on the roof? And those two things came about as a result of two different things. One, in the form of subsidy, there were rebates associated with solar. There were federal rebates, and then there were what we call solar amenable states, and California was one of those. There were about a half a dozen of those, where they had an additional state rebate. So the idea is, if you put solar on the roof, you get a rebate for doing it, but that still wasn't going to allow people most people to be able to write a big enough check to buy the equipment and put it on. And so then the additional part was private financing. And so when we made our investment at the time, Sunrun did not have a private debt facility of any scale available to it. And they were out negotiating with, I believe it was US Bank. And just as the economy was falling apart, they got a $100 million loan facility from US Bank. And that it was one of the big things that made the company in the early days. This is a comment from one of the executives, felt like we were on the last helicopter leaving Saigon, right? Because once that 100 million came into place, there were all these competitors that wanted to come behind, but they all starved out. They all got starved out because they couldn't get to capital. So that allowed Sunrun to, over time, become sort of the mega company that it's become today. But a key success factor, and you could argue really there are two elements to that business: brilliant consumer marketing, but super brilliant financial engineering, because they've had to raise billions and billions and billions of capital to be able to go and make it to where now hundreds of thousands, and eventually we believe millions of people, will be able to put solar on their home by just simply ordering it. It shows up, there's no money up front, and then they pay over time from that perspective. So long-winded answer there. We've looked at a bunch of other industries to try to see if they can be made amenable to this kind of power purchase agreement model, this PPA model. Energy efficiency, people have played with that with the PACE program and things like that. So far, it has been a lot harder to do that. So sorry for the long-winded answer. And Scott and Grégoire, if you want to chime in there, if not, we've got some other folks queued up, and we can get some other questions in.
I'll just make a quick comment. Is one, I'm a newly turned on Sunrun customer. My system turned on here about 2 weeks ago, and one of the things for me was the in-home battery storage, and so the folding in of all of these different electrification technologies, I think plays an important role. But I think kind of the basis of the question is kind of the whole point is that it's hard to take technology to scale. You have the technical chasm of death, the commercial chasm of death. How do you bridge that? And early stage companies need a lot of help, support, advice, opportunities to demonstrate their tech, patient capital. And these are all things and resources that, at least from, again, one of the reasons why Halliburton Labs exists is to help provide and kind of help to bridge that gap. But it's one of the big challenges for sure.
The next time I speak to Lynn Jurich, the CEO of Sunrun, I will share with her the story, because I can absolutely tell you 10 years ago, the idea we could get an executive from Halliburton in Houston to put Sunrun on their home was like, it literally felt like flying to the moon, and flying to Mars was going to be
very
easy.
Bottom of the target list.
So yeah, so that's outstanding to hear. Grégoire?
No, just to maybe to add things that it's also a big opportunity also for big infrastructures and large corporates to go to an energy as a service model. So right now, these models are really also very robust, which means that it completely changed the paradigm, the way you are investing in your own infrastructures and the way you are consuming your energy, relying on real experts that will deliver all these hardware, software, and services on your behalf to drive a much more sustainable activities. And financially wise, that are completely different, because all the assets are no longer in your balance sheet.
Fantastic. So I'm going to ask Greg Moeller to come in and ask his question. Greg, just please make sure you identify who you are and what company, and then go ahead and ask your question to the panelists. After that, we'll go to row A.
Okay, can you hear me?
Yes.
Hi, everybody. Greg Moeller. I'm calling in from Via Capital Management. My question to the corporate VCs is this. I've been an engineer my entire career, became a businessman, done some startups myself. And when I listen to a lot of the people that talk, I don't hear a lot about the cradle to grave waste stream of these various technologies that are being considered. And in fact, people get a little squeamish when you ask about it, because I don't know, I don't want to assign a reason, but what I sense is that the cradle to grave waste streams might not be as attractive as they advertise in their marketing brochures. Do you guys consider these things when you're making investments and compare among the various options? And if you do, which ones are coming out on top?
Yeah, so do you want me to take it? First of all, definitely that's what you are mentioning is very, very clear for us. And we are highly considering that, not only through the pure energy lens, but on the overall circular economy lens. You know that in that regard, the Ellen MacArthur Foundation is one of the top thought leader in that regard. And it goes beyond the pure, I would say, recycling part of the activities, either from waste, but it's really about how I can extend the life duration of the assets when they are on site, how I can reuse them, I can repurpose them, I can repair them, and then at the end, how you can recycle them, and when it goes to waste, how you can use the energy that are the ultimate residual value of an asset. But it really starts all across this life cycle and trying to go waste parts release the latest as possible. That's really the way, for example, we are really starting to work on that. We have mapped right now 16 different digital business models that are related to that all across the life cycle. And the way we are really trying to, first of all, make our investment is trying to really get closer to the asset instead, which is to make an asset much more reusable, repurposable, repairable, and so on, which are really new things that are happening in that field, and that drives most of our investment or our incubation studies right now. This is what happened. Now, when it purely goes, because this is also something which is also happening in the waste to energy, for sure, all these bio energies and all these activities are very, very relevant. The issue personally I face on that in that regard is in most of the case that local initiatives with making a lot of sense locally, but not driving some global business. So at least this is what we have seen, which from a global company like us is more complicated to tackle, despite the fact it makes a lot of sense.
I think that's well said. I think I'll just add that the idea of carbon accountability across all sorts of different sectors is a trend that will continue, and so it has to be something that we're solving for. And as an engineer, Greg, you appreciate boundary conditions, and one of the things that I think we will see more and more of is the right kinds of boundary conditions put around the various technologies that are being solved for. Certainly one of the areas that is of great interest to Halliburton Labs, and one of the areas that we look for is enabling technologies that look at kind of circular economy kinds of things. And so, one that is probably obvious is battery recycling. The amount of lithium and rare earth metals that are going to be required to achieve all of the different targets that have been put out there for EVs and others. There's just not enough global mining capacity that's active today. So we either got to get more mines, we've got to be better at recycling. And it's something that is one example of many that putting the right boundary conditions about full life cycle for some of these technologies becomes important. Windmill turbines, solar panels as they reach the end of their life, all of these kinds of things play an important role, and there's certainly going to be enabling technologies to help address a lot of those issues.
Fantastic, great. Okay, so then now we're going to go, and hopefully we should have, yes, we do have Roy Furman from Doral, and so another part of our international contingent here coming in from Israel. So please go forward, Roy.
Hey, good evening. Thank you very much for this very inspiring discussions. I would like to ask two questions. The first one would be that regarding tech transfers from the academia. So do you have sort of a methodology in place that you assess and validate the commercial viability of interesting IPs from the academia? And how do you leverage the gap between scientists into like startup and the transition that they need to go through? The second thing is regarding the bankability, or the banks and the insurance company that push back unproven technologies, and as a result, some of the business units can push back some technologies that you invested in, mainly due to the fact that there is a lack of or unwillingness to take some risks with bankability issues from the banks or the insurance companies to evolve such technologies in projects. Thank you.
Well, I can comment on the first one. I think that there is no doubt, we spent a lot of time with a variety of university systems. There's a lot of stranded IP in university systems generally. Some of it has to do with kind of the expectations from the university about how they monetize their IP. Some universities are better about making that available for early founding teams that are, either involved in developing the IP or whatever that might. There's certainly opportunity, and there isn't a university that I've had a conversation with that isn't trying to improve that approach and to drive monetization more effectively. I think that there is certainly opportunity there. I would say generally for us at Halliburton Labs, it touches a bit earlier stage than what we generally target. but we do get involved with university incubator programs and other things as a way to kind of drive visibility and deal flow and to kind of give back to kind of the startup community generally. There's not a great answer, but I think that those that do a pretty good job are the ones that marry up business schools with tech transfer offices and entrepreneurship programs to be able to put a business focused kind of founding team around an interesting technology. And so I'll leave it there though, Grégoire. I don't know if you got other comments.
No, quite a line here. Honestly, this is usually something that we are partially considering. We have set some partnership with big universities, trying to get, I would say, a better understanding on these technologies rather than, by the way, harvesting the pure IP part of it, which we are leaving that to the entrepreneurs to better understand how we can do that. But this is something that can be very, very time consuming. So we are trying to make some reasonable investments, time-wise, I mean, to leverage and to harvest these IPs. What we are trying better to do is, once we have decided to incubate something in a dedicated technological domain, we are looking from the most suitable universities where these topics have been already studied, and therefore trying to set some partnership in between these new ventures and the university itself, rather than directly from LC venture.
Fantastic. Great. Thank you very much, Rui, for weighing in on that. I'm looking forward to continuing our conversation. And I think we're pretty much out of time. I think we're just going to use the time now to wrap up. And first, I want to thank our panelists, Scott Gale from Halliburton and Grégoire Viasnoff. Can you pronounce your last name for me again?
It's Viasnoff. It's Russian.
Viasnoff.
Yeah, it's a Russian name.
Viasnoff. Okay, well, it's just like it looks. So Viasnoff, thank you. From Schneider Electric. This was really meaty. I mean, we really got to get into a lot of details, and we had some terrific engagement and interaction with our audience. And so I'd like to use this as a model for going forward, because I think we gave people a chance to really, interact and get inside you guys' heads. You're doing fantastic work. We're absolutely thrilled and proud to be your partners. If anybody in the attendee group has any questions about how you can execute on something like this, please ask Scott and Grégoire, and certainly ask me, and we'll be glad to take that up with you and go further. But we'll give you 2 minutes of your day back. Any final comments, Scott or Grégoire, to the rest of the group?
I mean, I would just say, again, appreciate the opportunity to be here. It's a fascinating challenge, and there's no right model. I think it has to be aligned with your strategy. It has to be aligned with where you're at in your own journey as a company. And there's lots of different combinations. And certainly, again, I'll echo, if people have other questions or things, feel free to reach out, find me on social media, and would love to connect and help in whatever way I can. So it's great to meet you all.
Definitely. Thanks, Paul, for the invitation. Thanks, Scott, for the discussion, and really looking forward to discussing with you all, because it's really an open ecosystem. Things are so bold and so large, then as you were mentioning, Scott, the way you can really gather all these pieces are just amazing. And definitely, personally, at least, I learn every day. So really looking forward to discussing with you. Thanks a lot.
Fantastic. Well, I'm very appreciative of the time, everybody, and thanks for weighing in. And we have a boring little topic that we're going to do coming up tomorrow. I think it's tomorrow. I hope I'm quoting this correctly. I don't see a date actually on it, but I think it's tomorrow. If it's not, then Angelica will correct us. But 9:35 a.m. Pacific time, 12:35 Eastern time. Just a boring little topic about how you should be earning carry as a corporate venture capitalist. So we're going to throw that grenade in the middle of the room and see what comes out of that when we get our session going. Now. Oh, sorry, it's Wednesday, 7/28. I should have known that. So thank you for the quick action, Angelica. So Wednesday morning, we'll get on there and mix it up with everybody around compensation. So All right, cheers. Thanks, everybody. Really appreciate the time, panelists, and thanks for the Mach 49 team. Great job. Really lots of ham and egging back and forth here. Great coordination. Thank you for all of our attendees. Really appreciate it. We hit about 100. That was exciting. Take care. Have a great rest of your day and your evenings.
Thanks a lot. Have a good day. Bye.
Bye.